Welcome back to Yield Nerd. Today, we're going to be looking at what could happen to agency bonds in the event of a hard landing and or the debt ceiling leading to the unthinkable potential default. So let's dive deeper. And before I go any further, please note that this is not investment advice. I am not a wealth management advisor. I'm not sponsored by anybody. I have no agenda for or against any particular trade. This is education and not investment advice. Well, the way we're going to look through this is first understand and remind ourselves again, what is the FHLB? There is an earlier episode that you can see the link right here. It talks about agency bonds in general, but we're going to dive deeper into FHLB. And we're then going to relate that to banks, small and large, and then start looking at what could happen to a bank during a hard landing, review what is happening already to banks and how the ground has shifted beneath them, and trust me, they have. And based on all of this, what should you do over the next 100 days? New visitors, there is a playlist in which this show is organized sequentially. You can find that playlist right there. Feel free to use that. And I'm going to continue on to the rest of the content. Let's step back and look at how the home equity process works. The government prints money. They then let the banks borrow from them. Banks borrow short term and they lend long term. So if they get 4% from the government, they may lend at 5% for 30 years or whatever it may be, or 6% at 15 years. And that difference is the profit for the bank. Now, banks don't have to borrow from the government. They may have deposits in the bank accounts that they can use to borrow as well. And there are reserve requirements, things like that. But that's the general concept. You then go get a home mortgage. You agree to pay the bank. You go buy your house. Kumbaya, life is good. That's the simple home equity process. How does repayment work? You are living in your house. You clip that little token every month that you get. And you say, here is my interest, here is my mortgage payments, some of it pays off the principal, eventually you pay off the entire loan, good for you, and the mortgage unwinds. The bank says thank you, they've been making a profit on your mortgage all along, you repay them, they say this is awesome, and the bank then repays its loan, and the government says thank you, the government makes tax revenue along the way, this wealth that was created along this cycle increases the GDP, and the home equity process comes full circle. Well, what happened during the Great Depression? The government still had the ability to pay money, the banks had the ability to borrow, except individuals had big problems. Institutions went out of business, people lost jobs, they were unable to pay the mortgage, and the banking system collapsed. This is in the late 1920s, the Great Depression of 1930, and Black Friday, as it is called. And banks couldn't even lend to people who were good credit risks because their deposits were getting wiped out. So what did the banks do? They went back crying to the Fed and said, hey, the economy is at a standstill. You need to help us. FDR was the president at that time. The alphabet soup came about and the FHLB was born. The FHLB says, okay, here's your charter. You are going to give liquidity to the market. You are going to go find small and regional banks, and there are many big banks that borrow from the FHLB as well. But you're going to go find the small and regional banks that serve the populations that otherwise would not have easy access to money. You're going to lend them, and we're going to treat you specially because you're doing that. And we'll talk about what that treat you specially means in a minute. So, what was the solution? The government still prints money. The FHLB now becomes not the lender of last resort, but the lender of next to last resort, if you will. The FHLB then goes to the bank and says, hey, you can borrow from me, and I'm going to give you a really good deal. You can then lend it long term, and go through the mortgage process and complete the creation of wealth. Don't worry, we have a lot of funds. We're a public-private partnership. And you know what is even better? We have a line of credit with the entity that prints money. How cool is that? So the FHLB has a line of credit, which means if there is a problem with the banks paying back, the FHLB will simply go to the government and say, hey, I need a little more time. Can you give me a couple bucks? And they can borrow against the line of credit, which is just fabulous. The end, we've solved all the problems with home equity. Unfortunately, not the complete solution. So now let's look at what is happening in small and large banks across the country. There is a Bloomberg article that I highly encourage you to read. It says US banks are finally being forced to raise rates on deposits. Any of you who have looked at your bank statements would have seen that bank interests were next to nothing, and they have now crept up to slightly next to nothing. And they pay 1%, 0.4%, some meager number like that. So think about it. If you can get treasuries for almost 5%, why is the bank not giving you the 5% or maybe even 3% on your loans? The answer is very simple, because they get to enjoy the difference between the 5% and the 0.25%. That is their profit. And this article shows that people aren't going to sleep through all of this. People are closing their CDs. The black line is the CDs. People are saying, I'm not going to put my CD in your account to get your 1.5%. I'm going to put it in treasuries. They are watching Yield Nerd probably. And not only that, the FHLB advances. Yes, the advances are decreasing, which I suppose is a good thing. However, the deposits in bank accounts are also decreasing. That doesn't mean people are becoming poorer. It simply means that when the Treasury pays a greater interest rate, the smarter population moves their stuff into money markets, they move it into treasuries, they move it into areas that pay 10 times the payment. So why bother with 0.45%? The market is responding. So if you're a bank, you are in a hot seat. You need to pay the FHLB its interest, but your deposits are cratering through the floor. Your CDs are down by a big amount. What are you going to do? Guess what? A bank really has four ways of getting money into the system. One is you and I putting our paycheck into the bank and not spending, which the bank loves because they get to keep your money. We could all go buy CDs and lock up our money for a long time at whatever interest rate they give us, which also frees up the capital for the bank to use. Or the bank can go borrow money from the FHLB. Or if you're a really big bank and you have offices elsewhere, or you can go to the borrowing desk in some other country and say, we are big bank XYZ, we're going to lend in the US, but we need you to buy our bonds. And the small regional bank can't do that. The large multinational bank probably can do that. So that's generally how a bank gets capital into its books. So if you can't do one of that, or maybe you want to do multiple of those, banks have now started to vastly increase their CD interest rates. Check this out, 5.5% on an 18-month CD. How amazing. We should all go buy CDs, spend every dollar of our last dollar that we have in the account, go to a local bank and buy CDs because they pay a lot. Small problem. Let's talk and remind ourselves of Yield Nerd episodes from earlier. State and local taxes are the key. Treasuries are state and local tax exempt. And so even though the CD pays 4.88 and the Treasury pays 4.89, you will want to add the 6% or 7% of state and local taxes to this, meaning in Illinois with a 6% tax, this would be closer to 5.2%. And that also doesn't work out at 6 months, doesn't work out at 9 months. Oh, wait a second, when you go to 1 year, you can buy agency bonds, and depending on the agency, FHLB and FFCB are those that are state tax exempt. Agencies are going to beat bonds in every single duration. So the folks that are going to keep their money in the CD in a bank are those that probably aren't yet hearing about yield nerds. Spread the word. Then you have to ask the question, if folks do wake up and say, wait, the CD rates just aren't good enough. I can make more money, in terms of tax savings in a treasury. I can trade it in a real-time market. Then what could happen? Let's stop and think. Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, welcome back. We are going to start talking about what would happen to the FHLB and its loans if indeed there was a hard landing, and what would happen to the banks to whom they lent money if indeed there was a hard landing. So let's talk about that. As you may remember what a hard landing is, and if you do not remember what a hard landing is, look at this episode which talks in detail about what it is and how it comes about. But effectively, three things may converge. One, an increase in unemployment. Inflation itself may or may not be sticky, which makes it worse. There may be a no landing scene, and GDP drops. When all those three happen, then there are fewer mortgages issued. Those who have mortgages may not be able to afford the really high mortgage payments, and loans may default. People may take cash out of the bank, which will decrease the deposit amount in the banks, which are already low. Once you suck the money out of the bank has a cash crunch and it needs to replenish those supplies, so it will be forced to do fire sales of the loans it has, and that fire sale is what will help it pay back the FHLB loans or not. Then you ask, wait a second, the FHLB is not going to get money from a bank if it goes under. What are we going to do? And then you realize, oh, the FHLB is the lender of next to last resort, as we call it. The FHLB is backed by the government, or so you think. And you may go to bed saying, no problem, the FHLB is untouchable, even if there is a default. One small problem with that thought process. Before we even go further, I want to tell you special things about FHLB loans so you could rest easy or not. Number one, the FHLB has an explicit line of credit from the US government. Hey, you know what? If the FHLB needs more money, the government says, I have a blank check for you. It's not exactly blank, but it has a pretty nice, limit, something like 4 billion and even more behind that. The next question is, what happens if indeed they blow through the limit and there is a problem? It's not explicitly stated that the government will come to their rescue, but in the past, when the FHLB did have a problem or the Farm Bureau had a problem, the government did come back and help backstop them. So even though it is not explicit, there is an implicit reading that these institutions are too big to fail. The government will come rescue them. The Fed does buy these loans and keep them on their portfolio, so there is that. And when you look at the bank's books, this is what is called a privileged status. The laws around it protect it as though it is a security, a national treasury security. So these are high, high up on the bank's balance sheet. So you may say, FHLB, I am sitting pretty, no problem. And when it comes to resolving the loan, FHLB payments from a bank have what is called a super priority, meaning it comes first above everything, even if that means you have to sell the bank's building to repay the FHLB. So it's pretty high up there. There are reasons why people feel good about FHLB loans. Having said that, let's look at the hard landing and the debt ceiling crunch, where there is a potential default with greater attention. As we discussed, unemployment, inflation, crash in GDP, loan defaults, banks have a crash crunch, banks try to pay the FHLB, they can't, or they can't pay the full dollar. The FHLB says, hey, Uncle Sam, can you print more money and give it to me so I can keep lending to these banks? And Uncle Sam goes to the printer to print money, except there is no paper in the printer, people. In the event of a default, in the event of a debt ceiling crisis, the government cannot print more money. And so a hard landing may be okay. A hard landing with a debt ceiling crisis will indeed bring the country down to its knees. And that is why we all say you do not want to wish for it. Having said that, what can you do just in case? Let's talk about it. In the short term, there will be panic. Assume that we're getting closer and closer to the debt ceiling sides. In all likelihood, the purchases of CDs will not happen to a great degree for all the reasons we talked about. The bank's finances, US Treasuries may be the ones that are highly sought after. The agency bond prices may actually go down or their yields may go up. And so if you have the stomach for it, there may be buying opportunity for agency bonds right before the debt ceiling date reaches. For all the reasons that I said, if the debt ceiling discussions go into high gear, there will be crises in the treasury market and the agency market. However, it will be nowhere close to the financial market, the stocks, preferred equities of banks, and other sector equities. Therefore, the safest haven, as unsafe as it may sound, in the event of the debt ceiling discussions going to a very, very critical point without triggering default, would still be short-term treasuries and not going past the July-August timeframe and not looking at duration. I have nothing against bank stocks, but given the debt ceiling and given where we are with our debt limit, they may not exactly be the place for you to hide at this time. You make your own decision. If you would like to discuss it more, there is my email. Thank you and have a good day. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.